mean, anything that is close to a population centre is probably going to get some sort of a premium to value. I think the valuation community has struggled with me, and I think all of us up here in general. And it's not, and they don't do it on purpose, but they're probably 6 to 12 months behind us. And where that is a challenge is the market is moving fast, and we're trying to bring valuers closer to the reality of what's actually occurring out there. And so whatever you see in a valuation report probably is 6 months behind, and based on what's happened in the market, it could be 25 to 50 basis points behind where the market is actually transacting. But in terms of building type, location and proximity to population is and lease term is clearly what drives value. So even a cross-dock facility close to the city centre where the 10-year income is probably going to get priced core. A big box in a good distribution hub or corridor with 10-year income is probably going to get priced pretty close.
Look, I think we're definitely, I can confirm we have the same experience with that as well in our portfolio. We see definitely a lag in terms of valuations in the portfolio compared to what is happening in the market. I think events happened quite quickly after last summer. And so, to some extent, it was frustrating for us to sort of see that that the values are lagging behind as to what you're doing, and obviously what is happening in the market. We see every day the comps of where things trade, and so there's some work to be done with values. There's some education to be done. It's obviously also the case that we might be in a position sometimes where we have perhaps more information about deal flow that hasn't filtered through yet. So these things do impact. It's also interesting what we, it has been mentioned quite a lot before, there's a lot of money flowing to the sector. What it means from my perspective is also that we want to be a bit prudent sometimes. I think there will be mistakes made by some investors who feel under too much pressure to invest, and therefore perhaps are a bit more reckless in their underwriting. So it's a very competitive landscape right now, which makes it interesting, and I think what is important is that you also see the same happening in the economy, in the underlying economy, and that we see that rental growth flowing through, and that will be important.
The agency teams, just speaking about our own organisation, are absolutely full tilt, and it's making sure that all that up-to-date information is translated real time or as much as possible into the valuers, and they're able to anticipate it, even if it hasn't actually been evidenced. I mean, there's a natural lag in transactions and the due diligence period and exclusivity periods. I think there's probably a lack of transparency in the build-to-suit market, and having developer traders involved and transferring that type of information, underwriting of development deals, which on forward committed or forward funding deals, you're asking people to do their underwriting 12 months in advance. And I think those types of transactions and having linked development capacities, whether whichever part of your organisation is doing that, is going to give you real-time information, and that there's a missing link probably there to a degree. I think also there probably just needs to be a more detailed look at all the main markets now. I mean, we're talking about the weight of money, pricing moving very rapidly. I think the big question is it all sustainable? And I think everyone here agrees it will be, certainly for the short term, but not just because of the weight of money. It's still a good value proposition compared to the US market in particular. So you see North American money coming in, there's still a significant yield spread there. There's still a significant yield spread over debt. There's still a significant yield spread over every other asset class. And if you look, we're just doing a piece of work now in preparation for our conference in May I add, looking at the 20 kind of key destinations in each country and beyond the obvious ports and airport related locations. 90% of those towns and cities and locations have vacancy rates less than 10%. And if you take out old stock, you end up with a vacancy rate that looks about 5% across the majority of the markets where most funds and occupiers are now focused. And if I pick a few out that I think are really interesting now, Prague is particularly interesting. It's got a 9% vacancy rate, but over 60% of that is in one park. If you take that out, you've got a 4% vacancy rate in that market. Krakow, Poznan, you've got 3 or 4% vacancy rates with deals being done. France, the main centres, Ile-de-France, Lille, and Lyon, for example, are all sub 10% now. And there are great markets in Germany outside of the ones which are usually advertised, but places like Stuttgart, etc. You know, it's an almost zero vacancy rate, and you can let warehouses that are 30 years old and don't have any sprinklers or heating, and it's just a kind of literally a tin shed.